now look at the whirlwind they're reaping from being able to do that. So none of that was possible without free cash flow. So it's very, very important. The next one we have is free cash flow per share projected growth rate. So what are your thoughts on that?
Yeah, kind of similar to the whole dividend yield situation. Something I wish I learned earlier and really internalized is this idea that, let's say when we look at valuation, let's say you determine that a stock should be valued at like $110. It's currently at like $99. So in theory, you buy the stock, you buy at 99. When the market realizes it should have been 110, now you've just made $11 on your investment. So that's kind of where the margin of safety comes in. And that can be a great way to make money in the stock market. Mm-hmm. The other thing to consider, though, is that you also have the growth that the company has. And so it all depends on what that spread is and how much a company is growing. So as an example, if I were to find a stock that's like, let's say it's 110, that's what I think it's worth. That's what the market thinks it's worth. But let's say it grows at like 10% a year. That investment is going to outperform something. Maybe you bought it at 99, but it's worth 110, but let's say that one only grows at like 5%. Even though you're getting the gain from 99 to 110, you're still losing because 10% over 10 years is going to beat 5% over 10 years plus what you're getting. It all depends on what the numbers ultimately are. And so if you make 50% on your money, that's going to do a lot more than like a compounder would. Mm-hmm. Yes. But you also do have to respect that the compounders can also outperform a value opportunity. And so you have to weigh both sides to that. And that's why when I'm trying to figure out what growth rate do I think free cash flow is going to grow at, that's probably the thing I spend the most time on out of this entire list. Mm-hmm. It's because that's what your money is going to compound at after the market adjusts. Either you were wrong or the market was wrong. Mm-hmm. Yes, it's a part of your return, but at the end of the day, it's going to be a big factor. So that's why the growth rate's so important.
It's probably one of the more important parts of valuing the company is what kind of growth rate do you think the company is going to grow at? Because to your point, you can buy something at a cheaper price, but if it's not growing as fast over a longer period of time, that's not going to matter. And so that's why determining the growth rate is such a critical part of it. And that kind of leads us to the discount rate. So what are your thoughts on the discount rate?
Yeah, not to get into the weeds, but discount rates kind of your opportunity cost. Mm-hmm. So, if I'm buying a stock and it only grew at 8%, I could have just bought the stock market at 10%. You want to try to account for that. And so that's what the discount rate does. Mm-hmm. To take a super complex, you could have 5 modules of, graduate level courses on it, but that's what you're trying to do. You're trying to look at the cash flows, you're trying to project it into the future, project the growth, and you're discounting it to the past to basically say, okay, we want to at least earn a certain rate of return on this. Mm-hmm. To make up for the fact we could have just invested it in the stock, in the S&P 500.
Right. Yep, exactly. I think of it as a hurdle rate. If the discount rate is 10%, that's the minimum I need to earn to buy this company and feel like I made a good investment. Some people, like Andrew said, there's a few ways you can go about attacking the discount rate. We're not going to go into them today, but you can go through a lot of math, or you can just set a flat amount, or you can use other rates, bond rates, and things of that nature. It depends on how you think is the best way to do it. Andrew and I like some of the math part of it, well, a lot of the math part of it. That's what we think is the best way to do it. But just think of it as the hurdle rate, or the rate you need to get to invest in this company. If I buy Visa and I set the discount rate at 12%, I expect to get at least a 12% return from plunking my money down for Visa. And if I don't, then that's a disappointment.
Yeah. And that changes depending on what company you're looking at. You could argue it should be all the same. I don't care what the investment is. I want a hurdle rate to be the hurdle rate, right?
Right.
But if you look at a group of stocks, if I'm buying a group of really high risky stocks, I would demand a higher return from those
Yes.
than something like a Visa,
Yes.
because a couple of those might blow up in your face.
Yes.
So if you can account for that in your valuation, then you're probably making better valuations.
Right. Very, very, very good point. All right, let's move on to solvency. So we have interest coverage ratio.
Yep. So I'm going to rapid fire on these. Each of the next three are just trying to look at, is this company going to sustain itself moving forward? So interest coverage ratio, do they have enough income to service the interest on their debt? So you literally just take operating income, you divide interest expense from the income statement. Both of those can be found in the income statement. And that ratio is interest coverage ratio. What's a good one in your opinion?
I've read anything less than 1.5 run far, far away. Anything greater than 1.5, I prefer anything like above 3, just to give myself a margin of safety. But yeah, this is one of those where the higher the number, the better.
Yes.
Net debt to EBITDA.
Yeah. So here's one that helps you get the sense of how much debt a company has. And because it ties to EBITDA, or that's like a profit metric. So it's tying it to how much money the company can make. And that removes some of the limitations that debt to equity has, which is more asset based. So yeah, it's good to just kind of figure out, I like to know if a company has a net debt to EBITDA of like 5, might not be a hard pass, but I should know that that's the case, and know that the debt's more important for a company like this than a company like Google, where it's like that's really zero because they have so much cash.
Next one, current ratio.
Yeah, this one, current ratio looks at current assets divided by current liabilities, and the higher the better. But basically, if they had to pay all their current assets, if they had to pay all their current liabilities, do they have the cash to do that? So I make a couple of adjustments when I do one of these. I include revolving lines of credit. These are basically, this is debt that they can tap to cover short-term things. So I include that. And then if you want to be an overachiever like I am, you can exclude inventory. And that's what we call the quick ratio, what the industry calls it. But basically, it's trying to avoid situations like Circuit City, where if you looked at the current ratio, yeah, they had a lot of current assets. Man, I'm screwing those up today. They had a lot of inventory, but you can't always assume that all inventory will be sold. So if you actually looked at Circuit City from a quick ratio basis instead of a current ratio basis, they really didn't have that much cash to cover what ended up putting them into bankruptcy. That's the big thing for that, is you're trying to avoid super bad situations.
Yeah. I liken the current ratio to, I have this much cash and I have these many bills. Can I pay the bills with the cash I have on hand? To me, it's that simple. The last year of negative earnings last 20 years.
Yeah, this is one of these like checks for me, because I don't like to buy, and this is just personal preference, but I don't like to buy a company that's going to lose money for 5 or 7 years in general. We laugh about it, but there can be some value there, but that's just not the game I'm trying to play. So I would like to know, if you look like a company like Uber or something who is not profitable on purpose because they were growing, okay, that's one thing. But if part of their business is we're going to lose money for 7 years and then we're going to make it all back in 7 years, that's just really hard for me. And so that's why I use this metric, just to shine a light on situations where that might be the case.
Right. There are some industries where there's the yin and yang of profitability and not profitability. I'm thinking like commodities, or maybe companies in the biotech, space that's just part of their business model. They go through ins and outs of making a lot of money and periods where they don't make much, if at all, any money. But to Andrew's point, that's just not a game I want to play. And more power and more, kudos to those who do, but that's just not a game I want to play. And so something like this can be very, very helpful. If you're looking at a company like Target and you want to invest in them and you see, they should be a profitable business. They've been around for so long, but if you see 3, 5, 7 years of negative earnings in a 20-year span, that might be a sign of other troubles that could not be good for you. So it's a quick way to just see, okay, is this company performing how I think they should? And finding any surprises. I don't think it's something you got to spend hours and hours and hours on, but it's certainly something you can give you a quick look and see, okay, are they performing as I think they should? Okay, next, move on to the next thing. All right. Well, with that, we'll go ahead and wrap up our conversation on financial metrics you should know. Hopefully you guys found this very helpful, and we love doing this. And so we will continue doing it. So with that, we'll go ahead and sign us off. You guys go out there, invest in a margin of safety, emphasis on the safety. Have a great week, and we'll talk to you all next week.